Okay. Hello and assalamu alaikum to Madam Maziza and to all my fellow friends. We are from Group 1, and for this, we are going to do a presentation of audit of the capital acquisition and repayment cycle as part of our audit assignment. So with that, let's get to it. So next. Okay. So first things first, we are going to start with the characteristics of the capital acquisition and repayment cycle. So in fact, there has been four characteristics of acquisition and repayment cycle. The first one is that there are relatively few transactions that affect the account balances, but each transaction is often highly material. So what this means for the first characteristics, it means is that you get a loan when you need you get a loan when needed, so it's you don't get loan yearly or monthly, so you only get the loan when you only need it, and it's only consists of large amounts because whenever it's considered a large amount, it's considered to be highly material. Secondly is the exclusion or misstatement of a single transaction that can be material. So that means um, let's say for example, you want to have a mortgage loan. So it can be like 1.2 million ringgit, or even a business loan. It will be around 500,000 ringgit when you want to get a business loan. So it only considers for one loan is equals to one large amount. So that is considered to be the exclusion or misstatement of a single transaction that can be material. Thirdly is the legal relationship between the client entity and the holder of the stock, which is known as shares, bonds, or similar ownership document. So what this means is that it can be a agreement between, for example, when you want to borrow a loan from the lender and the borrower. So that's the one form of legal relationship. Other than that, um, when you come to give dividends, which is for when you want to do it yearly on a yearly basis, it's a relationship between the shareholders and the management of the company. So that is what the legal relations of the it exists between the client and the holder. Finally, for the fourth one, a direct relationship which exists between the interests and the dividends account and debt equity. So for this, the interest is the loan that you receive from the bank. So as time went on, the interest rate starts to go up, as well as the principal. And dividends, when you have to give the shares in a yearly basis to the shareholders into account and debt equity. So that's for the four characteristics of the acquisition and repayment cycle. Next. All right. So I'm going to talk about the accounts in the cycle. So first things is the notes payable, which this means is that this is the amount of principal due on the formal written promise to pay. So this is basically like a loan. So in other words, it's like a loan from the banks. Secondly is contracts payable. So contracts payable is basically means that it is a contract, legally a contract agreement when you have to start a project between start a project of a company, you want to fund the project. So you do not rely on payable report alone and make a list of all the contractors on the project. So that's why I said. Third is mortgage payable. So this is mostly aimed towards property. So it is a liability account where it's the balance unpaid principal balance as the balance sheet date. And the amount of principal required to be paid within the 12 months of the balance sheet is reported as a current liability. So what this means that mortgage payable is considered to be current liability in the statement of financial position. Finally, is bonds. Finally, the one the account is accounts in is bonds payable. So this is basically a target. It's for large corporations, which are issued by corporations, hospitals, and governments as a form of long-term debt. So long-term debt is basically a non-current liability. So this is an example of this is that these public and utilities will issue bonds to help finance a new electronic power plant and then the capitals issue bonds for new buildings, government issue bonds to finance projects, cover deficit, or to pay for all the debt that is now maturing. So next. Okay. Next is interest expenses. So this basically this interest expenses is when you, as I mentioned to you before, is when you get when it is incurred once you get the loan acquired. So it is a non-operating expense shown on the income statement and represents the interest payable on any type of borrowing such as bonds, loans, convertible debt, or lines of credit. Uh, so it's basically calculated as the interest rate times the outstanding principal amount of the debt. So that's basically the formula of calculating the loan. So equals to principal plus the interest. Next is accrued interest. Is basically the interest expenses that is due but haven't paid on time. So if the interest if interest in if interest expense is already due but haven't paid, then maybe the loan can consider giving you a penalty because it is an outstanding amount. So the amount of interest that has accumulated on the debt since the last interest payment date. Next is appropriations of retained and earnings. This one is different from retained earnings generally because appropriations of retained earnings is basically targeted towards companies that consolidate with each other. Meaning, whenever you do a financial statement with a consolidated company, you might have to do adjustments of these calculations of these appropriations of retained earnings for each consolidation or and for the parent and the subsidiary. So appropriated retained earnings are any unappropriated retained earnings that are specifically not to be used for dividend payments. And then next is retained earnings that have been set aside by action of the board of directors for specific use. So this is basically the appropriations of retained earnings. And then finally is treasury shares. Basically, treasury shares is basically you do a share repurchase, buyback shares whenever the company will suffer profit loss, or if they consider their financial position to be unstable, so they have to consider to buy back shares. So this is the portion of the shares that a company keeps in their own treasury. So treasury shares may have come from repurchase or buyback from shareholders, or may have never been issued to the public in the first place. So that's about it for my part of all these accounts in the cycle. So I will have to give it to Zahin to present his part. Thank you.
So hi, I'm Zahin Adini Binti Zubari. I will proceed with the remaining accounts in the cycle. So for the seventh account in the cycle is the dividend declared. So what is dividend declared? It is a dividend that have been issued by the board of directors and been issued by the company and authorized by the board of directors, but haven't yet been paid to their shareholders. So dividend here is meant by the payment that the company have to pay to their shareholders in return of the capital that they have invested. So next account, so let's focus on the next account, which is the ordinary share and the preference share. So ordinary share here is meant by an equity instrument subordinates to all other equity classes. So for ordinary shareholders, they have the voting power during the AGM. However, the dividend declared under this ordinary share would not be fixed. It will depend on the company's performance after the company have paid their dividends to the preference shareholders. So whatever left there will be given to the ordinary shareholders. So next is the preference shareholders. So here preference shareholders includes all the corporate share where the dividends are paid to their shareholders before the dividends are paid to the ordinary share, as I mentioned earlier. So for preference share, unlike ordinary share, they have no voting rights. However, they are entitled for fixed dividends. So therefore, they will get their dividends before the ordinary shareholders get their dividends. So next accounts is the cash in bank. So cash in bank is meant by the current balance in the bank account. So it is the whole amount of coin, currency, and cash that have been deposited with a financial institution. So next slide. So let's proceed with the next account in the accounts in the cycle, which is the donated capital. So the donated capital is a gift of asset to a company, usually by state or local government, to induce a business to relocate to their jurisdiction, because the company is have agreed to build a charity building or facility at that place. The part of shareholders' equity is representing the fair market value of an asset at that time it was received as a gift. So here, the donated capital, it need to be declared as the company, as the capital in the company's account. Let's move on with the retained earning. So the retained earning here is can be measured by retained earning brought forward plus with the earnings before interest and taxes minus with the dividends that been paid by the company or any other distribution that have been paid to their investors. So the next accounts in the cycle is the dividend payable. So dividend payable is the dividends that have been declared by the company's board of directors to be payable to their investors. So next slide. So for the last two accounts in the cycle is proprietorship and the partnership. So for proprietorship, which is another word for it is sole trader or sole proprietorship, is an unincorporated business that have just one owner who pays the personal income tax on profit earned from the business. It is a type of business entity owned and operated by a single natural person with no legal distinction between the owner and the business, which means that the owner of this business have the complete control and will receive all the profit that the business gain. So it is the simplest form of business which one can operate the business, only one who operate the business and not a legal entity. However, the business who own and run the business is personally responsible for the debt. So for the capital account of the proprietorship, it will be shown as the owner's equity in the company's balance sheet. So next is the partnership. So partnership is where two or more parties are managing and operating the business and share their profit. So partnership capital account here is an equity account in the accounting record of partnership. In this partnership capital account, it contains of transactions such as initial and subsequent contribution by partners to the partnership in form of either cash or market value of other type of asset, along with the agreement of the others to the permanent endowment of the firm. So next slide. So we'll move on with the methodology for designing tests of balances for payroll liabilities. So for this methodology, it is similar with the methodology designed in the sales and collection cycle. However, it is different in the name of accounts, where the name of accounts here will be depends on what type of the company operates and how does the operation are financed. So for the first phase, phase 1, the first one is identifying the client business risk affecting the notes payable. So business risk here is meant by an exposure that the company need to face to a factor that they will lower or rise the company's profit. For example, is the state of the economic, such as inflation. So they need to identify how this factor can affect the ability of the company to generate profit. For instance, if the country that the business is running is currently facing high inflation, people in that country will only focuses on buying essential items such as which because of their lower purchasing power. So as the purchasing power become lower, it will result for some companies that doesn't sell the essential item to get lower revenues, which can result for them to gain loss. So due to the loss that they need to suffer during the year, they will have the difficulty in paying back their to their payables. The next point in this phase 1 is setting the tolerable misstatement and assessing the inherent risk for notes payable. So tolerable misstatement here is meant by the acceptable amount of materiality that the auditor allocate to the account balances. So usually they will set it at lower level at this phase because the audit usually can be completed successfully in this phase. In this first phase. So here they focus on how does the inherent risk can affect the notes payable. So inherent risk here is meant by a risk that is unavoidable. So for example, for inherent risk is the OPR. So inherent risk is also usually being set at lower level because usually the auditor can audit or determine the correct account value easily in this phase. So moving on with the last point in this phase 1 is assessing the control risk for notes payable. So how does control risk affecting the note payable? So control risk here is meant by something that you can improve which relates to the control activities or internal control. For example, is segregation duties. So for example of a situation is segregation of duties in recording loan and in processing cash disbursement for loan. So when the company have an adequate segregation of duties, it means that their control activity is good, resulting them to have a lower control risk and a lower chance of getting error. Next phase, so we're moving on with the next phase. So the second phase is designing and performing tests of control and substantive tests of transaction for capital acquisition and repayment cycle. This is for tests of control and substantive tests of transaction. So the last phase is the phase 3, which is first one is designing and performing analytical procedure for notes payable balance. Next is designing tests of detail of note payable balance to satisfy balance related to audit objective, which will include the audit procedure, sample size, items to select, and the timing. So we'll go deeper, which is first for audit procedure. So in this capital acquisition, it will utilizing all the audit procedure, which are the test of control, substantive test of transaction, analytical procedure, and test of detail balance. Next is sample size. So in capital acquisition, since the transaction is very few, the auditor will audit all the transaction, therefore there will be no sample size here. So next is the item to select. So here they focus on what related account to audit. For example, is loan. So in loan, they need to audit the accounts of interest expenses and the accrued interest expenses account. So lastly is the timing. So this depends on the audit procedure itself, where test of control and substantive test of transaction will be done at any months of the year, while for analytical procedure and test of detail balance, they will be done at the end of the company's financial year. So that's all from me. I will move on with the next presenter.
Hi and Assalamualaikum. My name is Nur Amira binti Muhammad Wahab. I will present about notes payable, its objective, and the internal control over notes payable. So what is notes payable? The notes payable is a legal obligation to a creditor which may be secured or unsecured by assets and bears interest. Legal obligation is a contract between a lender and the borrower, which lender is the bank, and the borrower is our client, which is the company borrowing from the bank. So notes payable can be secured and unsecured by assets. Secured by assets mean there is a collateral made against the assets, which the lender, which is the bank, can use when the borrower is not able to pay back the loan or have delayed payments. They can take over the pledge assets against the loans to gain back the money that is borrowed by the borrower. notes payable is basically like a promissory notes for the lender, and it is a type of loan. So next slide. So for the period, notes payable is issued for somewhere between 1 month and 1 year, but longer term notes also exist. It really depends on the type of loan and how big is the loan is. And notes payable is issued for different purposes, and the property pledged as collateral include a wide variety of assets such as security, which is a type of investments, account receivable, fixed assets, which is also a non-current assets, and inventory, and many other items that can be included. For principal and interest of the notes payable, it must be in accordance with the terms loan agreements. So it is basically depends on the period itself. So for short-term loan, the principal and interest is only required when the loan becomes a due, and the maturity period of the loan depends on the tenure of the loan, which is 3 to 6, 9 to 12 months. It varies on the type of loan itself. For a loan over 90 days, it usually calls for monthly or quarterly interest payments that have to be done by the borrower to the lender. Next slide. So there are 3 objectives of the audit of notes payable. The first one is internal control over notes payable are adequate. So auditor have to ensure that the notes payable are handled with proper internal control in order to avoid fraud and mitigate any risk. The second objective is the transaction of principal and interest involving notes payable should be properly authorized and recorded. This also have to be in accordance with 6 transaction-related audit objectives, which are existence or occurrence, completeness, accuracy, posting and summarization, classification, and timing. So for the third objective is the related liabilities and expenses should be properly stated. This should be in accordance with the 7 of the 8 balance-related audit objectives, which are existence, completeness, accuracy, classification, cut-off, detail tie-in, rights and obligation, and presentation and disclosure. Realizable value should not be included since it is not applicable against liabilities. For the third objective, auditor have to ensure that liabilities and expenses is recorded in the right account. For expenses, it include interest. It should be recorded in the right account, which is in SOCI, which is Statement of Comprehensive Income. For liability, which consists of accrued and balance on loan, it should be recorded rightly at SOFP, which is Statement of Financial Positions. Next slide. So for internal control, there are 4 internal control that auditor should assess. The first one is proper authorization for the issue of new notes. Authorization is the most important internal control of the notes payable, since notes payable usually requires a highly material goods, and it is in extremely large amount. So when acquiring or issuing new notes or new loan, it must be authorized by the board of director and management, which is in high-level manager, since it is their responsibility to do so, and they have to ensure that at least 2 signature is required for approval. Since only one single approval is dangerous, since, as I said earlier, the amount is extremely large, and fraud may happen if there is only one single approval for the notes payable. So for the second part, a second internal control, which is adequate controls over the repayment of principal and interest. So auditor have to ensure there is proper segregation of duties for the recording of loan, as well as the repayment and disbursement of the loan. So when the note is issued, the accounting department should receive the copy of the note, and the accounts payable department should immediately issue checks or electronic funds when the notes become due, to ensure that they do not have any penalty against the notes against the loan. So auditor have to ensure proper segregation proper segregation activities by ensuring recording liability is made by different person from person who made the disbursement entry. So the third internal control is proper documents and records. So since accounting department should prepare loan amortization schedule, they should have the copy of loan agreement to ensure that the data that they key in is in correct amount, and so that there is a presence of supporting documentation for payment, since it is important for the accounting department. So for the fourth internal control, periodic independent verification. So the company should hire an independent persons to reconcile disbursement as well as recording the liability against general ledger. This person should not be the person who record the detailed entry, detailed records, since they have to ensure no fraud happens within the company. And this person should have a few responsibility as well. They also need to recompute interest expenses, and this person should know and alert of the current OPR, which is overnight policy rate, since OPR is renewed every now and then. So for example, when the independent person is not alert of the new OPR rate, they may record the loan with the old OPR and not the new ones, and they may be undercharged or overcharged amount against the that is paid to the bank. So when there is overcharge, it is fine, since there will be no consequences such as penalty. But if it is undercharged, the bank will record it as late payment, and they will charge the company with penalty, and bad consequences will happen, which is expenses will be increased by the company. Next slide. So these are the related interest account for notes payable. There are three main accounts, which is notes payable, cash in bank, and interest payable. So for notes payable, the payments of principal will be debited, and the issue of new notes will be credited. So cash in bank happens when bank disperse loan and cash is earned. So when bank approve, the loan amount will be debited into the account. So they have to debit the issue of new notes and credit the payments of principal as well as payment of interest. For account interest payable, it is when interest is due but not yet paid. So they have to charge it and record it as liability. So under interest payable, payment of interest will be debited and interest expense will be credited. That's all from me. I'll pass to the next presenter.
So I am the Chef Accountant Exec, and I will be presenting about audit procedure and audit objective. So first, I'll start with audit procedure. So test of controls and resources. Test of transaction. The test of control is an audit procedure to test the effectiveness of a control used by a Korean entity to prevent or detect material misstatement. So for test of control on notes payable, they must emphasize on the four internal control that has been mentioned before by Amira, which are proper authorization, adequate control, proper document and record, and lastly, independent verification. While substantive test of transaction is known as a phase of audit, where the auditor gathers sample to identify any material misstatement in the client's accounting records or other information. So the test of a notes payable transaction involve accurate recording of receipt from notes proceed and the repayment of principal and interest. So other than accuracy issues for test of control, we must make sure that there is a proper approval for disbursements. For example, if the total loan of the first monthly installment is 20,000 ringgit. So we need to ensure that there is a proper approval to release this loan payment, as this involves a large amount of money, which is highly material. So this is the same for substantive types of transaction. We must do recomputation because it involves maturity of individual transaction. As I said just now, it involves a large amount of money. So the staff in charge to record the principal and interest must do recomputation. So even if the company uses a system to calculate all the interest rate, they still need to do recomputation because there's a possibility the staff may accidentally wrongly key in the interest, and this will affect the amount of disbursement that will be processed. So this is also another reason why independent verification is needed. Next. Next is analytical procedure. So what is analytical procedure? So analytical procedure are performed as an overview of the financial statement at the end of the audit to assess whether they are consistent with the auditor's understanding of the entity. So first, analytical procedure is a recalculate interest expense on the basis of average interest rate and overall monthly notes payable. This means that the auditor still needs to recalculate because but this recalculation will only reflect on the year-end balance. So auditor will need to check the loan amortization schedule and recompute whatever that has been recorded to check for any error. So this is to avoid the possible misstatement, which is a misstatement of interest expense and accrued interest, or omission of note payable. Omission here is referred as unrecorded loan. Next. So another analytical procedure that can be performed is to compare individual notes outstanding with those of the prior year. This is to avoid the possible misstatement of omission of a note payable. And another analytical procedure is to compare the total balance in notes payable, interest expense, and accrued interest with prior year balance. This is to avoid misstatement of interest expense and accrued interest or notes payable. So how are we going to compare these balances? Next. Next. Okay. So these two figures here are an illustration of a typical schedule that consists of a detailed information of all transactions that occurs during the year. So all information stated here are like the beginning and ending balance of notes and interest payable, and descriptive information about the notes like due dates, interest rate, that are pledged against as collateral. So from this schedule, we are able to compare the balance of current year with prior year, be it the balance of notes variable, interest, or accrued interest. All of it is stated in this schedule. So next. The last one is major balance related audit objective to notes payable. There are three most important balance related audit objectives in notes payable, which are completeness, accuracy, presentation, and disclosure. So for completeness is to ensure that existing notes payable are included. This is an important issue because client may not record their loan as loan increase liability, so they want to manipulate their profit. Or as okay. Next is accuracy. So accuracy is to make sure that notes payable in the schedule are accurately recorded. This is because client may understate their interest expense as they may not be aware of changes in the OPR, or they purposely understate it to manipulate the amount of profit. And the last one is presentation and disclosure. This is important because if we have a secured loan, we must disclose about the pledge accept in the notes to the account. And lastly, existence or occurrence is less important for notes payable. This is because company will not create any fictitious loan as it increase liabilities of the company, and which will affect net asset to decrease, and there will be going concern issues. That's it from me. I'll pass the next slide to Lexi.
Hi, Assalamualaikum. My name is Razana binti Karinizam and I will proceed with the next slide, which is regarding honest equity. So basically, there is important difference in audit of honest equity between the publicly and closely held corporation. For closely held corporation, it is typically have few shareholders. Occasional transaction, if any, occur during the year for capital share accounts. So basically, the only transaction entered in the honest equity section are likely to be the change in honest equity for the annual profit and loss and the declaration of dividend, if any. They rarely pay dividends, and auditors spend little time verifying honest equity, even they must test the corporate records. Meanwhile, for publicly held corporation, the verification of honest equity is more complex because of the larger numbers of shareholders and frequent changes in individual holding the shares. So the test for verifying the major honest equity accounts in publicly held corporation includes capital and ordinary shares, retained earnings and related dividends, and paid in capital in excess of par. Next. So basically the objective is internal control over capital share and related dividends are adequate. Honest equity transactions are correctly recorded as defined by the 6 transaction-related audit objective. Honest equity balance are properly recorded as defined by the 8 balance-related audit objective, properly presented and disclosed as defined by the 4 presentation and disclosure-related audit objective for honest equity accounts. Next. So this is the illustration for accounts honest equity and dividend. Next. So next is internal control. Basically, there are 3 internal control. First is proper authorization of transaction. Since each honest equity transaction is typically material, many of these transactions must be approved by board of directors. There are 3 types of honest equity transaction which usually require specific authorization. First is issuance of capital share, where the authorization includes the type of equity to issue, number of share to issue, par value of the shares, privilege condition for any shares other than ordinary, and date of the issue. Second, a repurchase of capital share, such as the repurchase of ordinary shares or preferred shares, timing of repurchase, and the amount to pay for the shares should all be approved by the board of directors. Third, declaration of dividends, such as the form of dividends, amount of dividend per share, and records and payment dates of dividend. Next is proper record keeping and segregation of duties. Internal control must be adequate when a company maintains its own record of shares, transaction, and outstanding share. They must ensure that actual owner of the share are recognized, correct amount of dividends is paid to the shareholders owning the share as of the dividend record date, and minimize potential of misappropriation of asset. Last but not least, independent registrar and share transfer agent. Any company with share listed in a securities exchange is required to engage an independent registrar as a control to prevent improper issue of share certificate. Basically, the responsibility of an independent registrar is to make sure that share is issued by a corporation in accordance with the capital share provisions in the corporate charter and authorization of board of directors. Most large corporations also employ the services of share transfer agent to maintain the shareholder records, include those documenting transfer of share ownership. It helps strengthen control over the share records by putting the record in the hands of an independent organization and help to reduce the cost of the record keeping by using a specialist. So that's all from me. I will pass the slide to the next presenter. Thank you.
Okay, thank you, Rana. So next, I will move to the last part of this presentation, which is the audit of the capital share and paid in capital. So in this part, we will talk about the audit objective in the cycle, which is mostly focused on these four components, which is the completeness, accuracy or existence, accuracy, and the presentation and disclosure. So about the presentation and disclosure, we may refer to the MOA. So what is MOA? MOA is the Memorandum of Association. So MOA provide the documentation of the company, which in the documentation, there will be the basic information of the company, right power of the company, registered name of the company, and any related disclosure that need to disclose by the company. So the auditor can refer to the MOA document, the document provided by the MOA, and to refer about the any information of the company. So next we move to the completeness. The auditor need to ensure that all share in the company are recorded. So the next is existing and accurate. So the auditor itself need to ensure that there is no fictitious shareholder in the company. But in this case, in this cycle, this might be rarely happen because if the company make a fictitious shareholder, as mentioned by Shavika earlier, the company will need to pay more dividend for the shareholders. So there is no point that the company will do this kind of activity. The last one is accuracy. Uh, this will is used to verify correct amount recorded. As for example, uh, the dividend of the company for that year is 6%. So the 6% will be times by the profit of the company, and the amount will be give to the shareholder. So the auditor need to ensure that the amount is correctly recorded to all the shareholder in the company. So next we move to the next slide, which is the audit dividend. In this part, there will be related to the second slide, which as you can see, the occurrence, number 1 and number 4, number 2 and number 5, number 3 and number 6. So I will explain one by one. For the first one is the occurrence, record dividend occurred. This is to ensure that the validity of the dividend expenses. So for number 4 is to ensure that the validity of the shareholder, either the shareholder is exist or not, and this related to the fictitious shareholder as I mentioned earlier. And number 2 is completeness. Uh, to test the existing dividend are recorded, and compared to number 5, dividend payable are recorded. So the difference between these two is the number 2 is recorded as an expenses in the SOFI statement of financial position, and number 5, dividend payable is the actual basis, which will record in the SOCI, comprehensive income. Number 3 and number 6 also related, which is the number 3, dividends are accurately recorded, which is this considered as an expenses for the company, which we will record in the SOFI financial position, and the accuracy for number 6 will record as an accrual basis in the SOCI comprehensive income. So the last part of this slide is the audit of retained earning. So the possible transaction involved in this retained earning is the net earning for the year and the dividend declared, and the possible correction and adjustment in this cycle is the period of earning, period of adjustment, and appropriation of retained earning. So appropriation of retained earning has been explained by one of the group members in the earlier part, which is retained earning. Retained earning and appropriation of retained earning is not the same thing. Appropriation of retained earning is the allocation of amount from the retained earning that we will call a reserve. So what is the function of the appropriation of retained earning? Appropriation of retained earning is the allocation of money that put aside with the approval of the board of directors for the specific use for the company. As for example, the company want to make an expansion of the company in the next year. The company can use the reserve money for the capital of the expansion. So I think that's all from our group, and that's all from our group for this cycle. This topic. That's all from us. Thank you.